This lecture focuses on advantages and disadvantages of exchange traded funds. Exchange traded funds have following plus points. Number 1, ETF prices change continuously all through the day of trading, whereas conventional open and mutual funds only trade once a day after the close of markets. This enables to manage ETF almost instantaneously in any part of the day, doing rebalancing and asset allocation among various classes of assets. This flexibility is not available with open and mutual funds, whereas it becomes difficult to make structural changes. The additional flexibility of ETFs comes from all trading strategies available to stocks, from derivatives to stop loss orders to application of derivatives for risk management. Number 2, ETFs have relatively lower administrative as well as MER costs. Lower costs imply greater opportunity of returns since MER is not paid directly by the investors. Rather, it is deducted from the gross returns. In addition, ETFs have lower overhead and brokerage costs. Discount brokerage, in particular, is a great saving to purchase ETFs. The commission paid on ETFs is much lower than that on open end mutual funds. Number 3, when you are using non registered taxable accounts for ETF investments, you accrue a much lower tax bill than a similar mutual fund. ETFs would in most cases retain capital gains and not distribute it to the shareholders. There would be capital gain taxes on ETFs, but only if the proceeds of disposition are greater than the adjusted cost base of funds. Now coming to some of the disadvantages of ETFs. Number 1, there are transactions trading costs for ETFs and the investors have to open a brokerage account and pay commission toward the purchase of shares. Although there are low MERs of ETFs, there are more transaction costs creeping up if the frequency of sales purchase increases phenomenally. Number 2, there are hidden costs of ETFs in the form of tracking error in an ETF. The tracking error, which calculates the amount of deviation from the underlying target index, cannot be voided in certain circumstances. More specifically, it cannot be voided due to the non synchronization of cash flows, dividends between ETFs and the underlying securities. Tracking errors or hidden costs become more magnified in volatile markets.